All right, so this is just a brief overview of what we're going to talk about. So the benefits of investing in real estate. For rental real estate, with rental properties, you're going to have a steady cash flow from your rental income versus, most other types of investments, you're not going to have a cash flow every month. You're not going to have, unless you, maybe like a dividend stock, you might get a quarterly payment or something, but real estate is like really the one asset where you're going to have a check coming in the mail every month. On top of that, your tenants are paying down your mortgage. So it's, like when you own your house, you pay the mortgage every month, the balance goes down, and it goes down more and more over time. The longer you own it, the more principal you start paying. So, you're building up that equity. And then, and really on top of that, you're getting appreciation. Your property value, more than likely, as long as you bought in a good area, your property value is going up every month as well. So you're getting the mortgage paid down and the appreciation. So you're getting, over time, you're getting more and more equity built up. And then your rental income is going up every year as well. So you're just building momentum as you go every year. There's a lot of tax benefits for investing in real estate. It's probably more tax benefits for real estate than any other investment if you take advantage of all of them. Like depreciation, especially in the first several years, buying a rental property can essentially wipe out all of your taxes, so that rental income is going to be tax-free. Eventually, when your rental income has reached a certain point, that's just going to outpace the depreciation. But you're going to pay very little taxes on your rental income. And you can also use leverage, which is financing, to increase your returns. So, say if you buy a $100,000 property and it goes up in value 5%. So it's worth $105,000 and you've made a 5% return. But if you finance that property and you put $25,000 down, that $5,000 gain is now 20% gain on your initial investment. So what if instead of buying one property, you bought 4 properties with $25,000 down? And now instead of making $5,000 in appreciation, you made $20,000 with the same amount of money as if you had paid cash for one property. All right, so identifying investment properties. How do you find an investment property? There's a lot of ways. With the MLS, that you're going to, if you work with an agent, your agent's going to have access to the MLS. There's a lot of ways they can search that to look for rental properties. If you were looking for a flip, they might maybe look at the lowest price per square foot in a certain area to get some ideas on, maybe these are potentials. Your agent, if you're working with an agent, they should have like an automated search set up where it's sending you properties regularly. They should also just be able to, look at the new listings and see which ones might work for you if you've talked to them. And then there's real estate investing groups. I find a lot of deals for clients on Facebook real estate investing groups. There's a Middle Georgia real estate investing group. There's Atlanta groups. There's groups for every area, and there's a lot of deals on those sites. Something called driving for dollars. That's where you're essentially going to go out driving through neighborhoods looking for rundown, distressed properties, abandoned properties, take those addresses down, and then you're going to go send letters to those property owners. Look on the tax records, find the owner, send them a letter, and try to get them to sell you their property. And if you send 100 letters, you'll probably hear back from 1 or 2, and you might be able to get a property for a big discount that way. So if you can get a property like that for a huge discount, you can end up with a lot of equity. So, and there's other ways you can go to auctions, real estate auctions. It can be a little riskier starting out because you're not going to be able to look at the property beforehand. And then networking with agents, other investors, just anyone in real estate, in general, lenders, contractors, anyone that's in the real estate business every day is gonna know about properties that are coming up. The more people you network with, the more opportunities are going to open up. And then assessing property value and ROI. So how do you know what a property's worth? How do you know what it's going to be worth when, say, after you fix it up? So what you're going to do is look at comps. Don't use Zillow, because all Zillow does is look at the properties in a certain radius. And the problem is you might have a really high-end neighborhood next to a lower-end neighborhood, and they're just going to take averages, and that's not always going to be accurate. Zillow can be way off sometimes. It can be off by $100,000. I mean, I would totally ignore Zillow and look at properties in the same neighborhood or immediate area that have actually sold that are similar, and that could be a whole class on its own on how to look at comps and analyze comps. And really, if you work with an agent, they'll do that for you. But don't just look at Zillow or an online calculator that tells you what your property value is, because they're probably not going to be right. All right, so cash flow and appreciation. So what is your cash flow? Your cash flow is what you have left after all of your expenses. So your expenses are not just, it's not just your rent minus your mortgage. You got other expenses, or other expenses that you should be accounting for that are going to hit you at some point down the road. So you got your mortgage is going to be your principal, interest, taxes, and insurance. Your vacancy rate. At some point, if you've got a rental, somebody's probably going to move out, and you may have 1 or 2 months with no rental income. So you want to factor in a little bit of savings to put towards those time periods when you don't have a tenant in the property. Then you also want to save for capital expenditures, which is things like a new roof, new HVAC, new water heater. So those are things that you know you're going to have to replace at some point. And if you're spending all that rental income and not setting aside, then what you're going to do when you need a new roof that might cost you $30,000. So repairs, you're going to budget for repairs. That's separate from capital expenditures. These are things that, so with capital expenditures, you know roughly how much life your roof has left and your HVAC. You don't know what's going to break at any given time. So you're going to budget separately for repairs. And then if you're not managing the property yourself, you're hiring a property manager, you'll budget for that. So, that could be, all these expenses added up, could be an extra 25% on top of your mortgage. So, and if you're going to self-manage, which you probably should try to do starting out, just so you can build momentum and save money, that'll save you 10%. So you may be looking at 15% expenses instead of 25%. Now, your appreciation, we briefly talked about that. That's just your property value increase over time. Typically, it's 2 to 5% a year. But the last few years, it's been significantly more. That probably won't continue forever, but with the housing shortage that we've had locally and really nationally, it's caused a lot more property appreciation. And then, so we need to think about balancing immediate returns with future growth. Where real estate is probably not going to make you rich overnight or in a year, but you stick with it, in 5 years, 10 years, you start picking up momentum and growing faster and faster and faster. So, don't expect to just quit your job and start real estate investing, and be killing it in a year. It's going to take some time, but as you grow your portfolio, you start building up more equity, your rents start going up, while your mortgage is staying the same, you're going to start building more and more momentum. And then we've got market factors that influence both aspects that you need to be aware of. Location is definitely the biggest one. Where you buy a property, that's the most important factor. If you buy in a bad location, that's a declining location, you might actually see your property value go down, which is the opposite of what you want. But at the same time, some of these lower income properties, you're going to make a lot more cash flow in terms of rental income. So there is a trade-off. If you buy in a really growing or rapidly growing area, you're probably not going to get a lot of cash flow every month from your rental income, but you are going to get a lot of appreciation. So it's kind of a give and take. It's one or the other, or you can find somewhere that's a balance of both. But if you want really high rental income, most of the time you're probably going to have not as great appreciation. Unless you just happen to find a great deal in a great area, then you should snatch it immediately. We've also got economic conditions like employment or employment opportunities in the immediate area, inflation, economic growth, and then interest rates. That's definitely going to play a big factor. Interest rates play a huge role in how much you're going to be able to afford, how much of a return you're going to get. But that doesn't mean that just because interest rates may be a little higher that you can't make money. You can make money in any real estate market. Regardless of the conditions, there's always a way. You just may have to change your strategy. About 3 years ago, you could have bought just about anything and made pretty good cash flow. But now you might need to be focused more on appreciation and thinking long-term, rather than just thinking you're going to get $500 a month off of a $200,000 rental property. Sorry, $500 a month profit. And then there's supply and demand. Right now, there's definitely a housing shortage, so that's causing rents to go up and prices to go up. If there was a surplus, we'd see the opposite, but I can't see any time in the near future where that's going to happen, because there's just such a big shortage, especially in middle Georgia. So time frames, there's different strategies. Some are better for short-term time frames. Some are better for long-term. Long-term, the main long-term strategy is buy and hold for passive income. So you buy a rental property, you just collect the rent every month, and you hold on to the rental property maybe indefinitely. You just increase the rent annually, and you just keep collecting that income, paying down the mortgage. That's really probably the safest strategy. You got some short-term strategies like flipping. I think the biggest thing people don't think about it with flipping is the tax liability. So you're going to pay some pretty steep taxes on your profits when you're flipping. Now, a lot of investors do flip properties so that they can take that money to put into more rental properties, and that can kind of help offset some of your taxes. Airbnb, that's another strategy. Short-term rentals. Short-term rentals you're going to get a lot more cash flow, assuming that you buy in an area where people are going to be, wanting to do short-term stays. Like if you buy in a vacation market, or if you buy in a urban market, a lot of times gets a lot of short-term rentals. But you don't want to buy an area with no real short-term demand, because then you're just going to end up with a long-term rental. And your whole strategy is going to have to change from, well, I thought I was going to get $2,500 a month in short-term rental income. Now I'm going to get $1,500 a month in long-term. And are you able to even cover your expenses now? Are you going to have to look at getting out of that investment? So that's something that you need to really look at before you try to do something like that. And then there's the BRRRR method, which is buy, rehab, rent, refinance, and repeat. So you buy a distressed property that needs a lot of work, you fix up the property, and you find a tenant, you rent it out, and now since you bought it distressed and you bought it at a low price, after the rehab, it's going to be worth significantly more. So you can refinance and pull cash out, do a cash out refinance to buy another property. So it can really be like a never-ending cycle if you do it properly. To determine what strategy you want to use, you may pick one, you may use a combination. You need to look at your risk tolerance and your goals. What's your goals? What's your time frame? Are you trying to, are you trying to plan for retirement? Do you have some other goal? Do you want cash flow now? So those are goals you need to think about. And then also time commitment and management. If you want to do an Airbnb and you're going to manage it yourself, that's going to be really time intensive. You're going to have either it's going to be time intensive or you're going to have someone else manage it, which is going to probably cost you 25% of your income on an Airbnb. So if you're going to manage it yourself, you got to think about cleaning. You got to think about, the guest check in and check out, and when things go wrong, something breaks. Managing your Airbnb account. Dealing with reviews. A lot of factors. So that's going to take a lot of time if you want to do something like that. But managing a long-term rental is going to be significantly less time than a short-term rental, but there's still going to be a lot involved, and it's going to be a learning curve. So it's a balance between, do you want it to be more passive or do you want to be more involved for a higher return? Talk about liquidity in real estate, meaning how do you get money out, or how easy is it to get money out of real estate? So it's definitely less liquid than, a stock portfolio where you could just sell your stocks and you shortly after you got the money in the bank. So there's different ways to get money out of real estate. So there's three real ways to get money out. You can do a home equity line of credit if you've got enough equity, where you just have a line of credit that you can spend against, or you can do a cash out refinance, where you're gonna, say you've got 50% equity in your house, you can probably pull out 25% doing a cash out refinance, and maybe 30. It depends on the lender. So that's one way. And when you do a cash out refinance, you're not going to pay tax on that money like if you sell. So that money is it's really a loan, so it's so it's not a loan, but you're pulling equity out of the property, so you're not going to be taxed on that. So then you can reinvest that into more properties, and then you can also sell. You're going to pay tax, capital gains tax, when you sell, more than likely, depending on how long you've had it. And but you can do a 1031 exchange where you sell a property, buy another property, and then you won't have to pay that tax if you reinvest it into another property. So that's the best strategy as far as taxes go with real estate is to stay invested in real estate forever. As long as you keep investing in more real estate, you can defer those taxes forever. You may never pay any capital gains taxes if you just stay invested in real estate. And then there's market cycles as far as exit timing goes. If you do want to sell a property, you want to make sure that you're in a situation where you don't have to sell a property when it's not a good time to sell. You want to be able to sell a property when it's a hot seller's market, and then hopefully by then you got the experience and the network to be able to find good real estate investments to put that money back into after you sell, even in a hot market. So that's you don't want to be forced into selling at a bad time. And that goes along with having cash reserves and emergency funds. You don't want to buy a property, say you put $25,000 into a property to close and you got no more money in the bank, and then your HVAC breaks next month. You don't want to be in that situation.
House poor.
Exactly. Yeah, you can be house poor as an investor too. So in transitioning to commercial real estate, if you stay in real estate investing long enough and you acquire enough properties, you're probably going to eventually want to convert to commercial investor, because you're not going to manage 100 properties, 100 single-family houses, or 50 probably, or 30. By the time if you get up to like 20 plus houses, you're probably going to be thinking about buying a multifamily property, selling those and buying a multifamily property, or maybe you can get into commercial or industrial, office or industrial or retail. But it's just it's part of scaling. When you scale up, you can buy so many houses and then it just gets inefficient, where it's much more efficient to buy commercial properties. But there's a lot more involved in commercial properties, a lot more analysis, so financial analysis, market analysis, lease structuring can be really complicated. You need regulatory and legal knowledge, negotiation skills. Now, you're going to work with a commercial realtor. You're going to work with a attorney that's going to help you with the lease structure and the regulatory and legal part. And negotiation, you'll have a commercial agent that'll help you with that. But still, you want to have an understanding of all these things so that you know what you're doing, and you know the people helping you. You can look and say, okay, does this make sense? You want to check behind everything. So this is just something to think about down the road. It's not something most people don't start out in commercial real estate, but it's just the next step down the road. There's just potential for much higher cash flow and scalability. That's why people eventually transition from residential to commercial real estate. So I'm going to go over a scenario real quick on what it actually looks like if you buy a property and hold it for 10 years. So these are all hypothetical numbers. They're pretty reasonable. You could do better or worse. Just depends on real estate. We're always specific on the specific deal that you're looking at. So in this example, we'll say you buy a property for $150,000 and you put 25% down. So you're financing 75%. You got 7% interest. This is your mortgage payment with taxes and insurance. PITI, that's principal, interest, taxes, and insurance. $1,055. And you're charging $1,500 rent. So you're budgeting for maintenance and repairs $125 a month, vacancy $75 a month, capital expenditures $75 a month. Now, of course, you're not actually spending all that every month. You're setting that money aside for when those things do come up. So your total expenses are $1,330. So that makes your cash flow $170. Now, a lot of people make a mistake and say, well, I'm making $1,500 rent and my payment's only $1,055, so I make $445 profit every month. And the problem with that is when something breaks or when you have to replace something, well, now you haven't set that money aside, so you are going to be in trouble. So you got 170 is the cash flow that you can really do something with without putting yourself in a bad situation down the road. So that doesn't sound really that great for, you're putting 25% down on a $150,000 property and making $170 a month. But you got to look down the road. In year 5, your rent, if it's gone up, say 5% a year, is at $1,914. So it's gone up $415. Your expenses have stayed the same. So now your monthly cash flow is $584 after accounting for all your expenses. You've had $41,000 of appreciation and $6,600 of mortgage pay down. So now you got over $85,000 in equity in 5 years. And now, so in 10 years, your rent's up to $2,443. Your cash flow is at $1,113 from one property, and you've got $94,000 in appreciation, $16,000 in pay down. So your total equity is $148,000 in 10 years. So your initial investment was 25% of 150, so I think that's what, 32.5. So now you've got 148,000 in equity off of that. Plus, you've got every month you're making over $1,100 profit, and that's one property. So what if you bought a property every 2 years or every 3 years? So you see how this can just grow faster and faster and faster the longer you hold on to properties and the more properties you buy. So that's the importance of thinking long term and not just looking at 1 year, because 1 year, year one, it didn't really look like that great of an investment. But after 10 years, it's a totally different story. So
I'm going to kind of talk about the basics of investing, how to consider what your your goals, your plan, how real estate fits into your portfolio in general. And so I'm a financial advisor with Northwestern Mutual Wealth Management Company. I'm also a registered, life insurance agent with Northwestern Mutual Life Insurance Company. We got a ghost in here. And so the benefits of kind of looking at both being securities registered and kind of also being an expert on your financial plan is when I help clients evaluate decisions, we look at how it fits into the context of your individual plan. and how real estate can kind of be part of your portfolio. I have several clients who, want to own, property, either to build up a, kind of equity, a concentrated asset over a long time horizon, or for cash flow on a monthly basis through rentals. And so we're going to kind of talk about some of the basics to investing, how real estate fits into your portfolio, and the big takeaway that I want y'all to take from me is that I'm a financial advisor who is willing to sit down, talk to investors, kind of be creative with how we can kind of get funding, what we can do with real estate, and how it fits into your plan. So, there we go. Before we get started, I want y'all to understand whether you're investing in real estate, whether you're investing in the stock market, any kind of investment, the volatility is a natural part of investing. And just kind of buying a rental house, buying an individual stock or equity, there's going to be ups and downs. And so making sure you have the right plan, you do your homework, you do the research before you kind of jump in with both feet. When we consider investments, and to consider whether it's kind of an asset, an equity, or a property, there's kind of really 5 kind of steps. Goal setting, what's the risk reward, diversification, discipline, and momentum. You heard Drew say a couple of those words earlier. He kind of stole some of my thunder a little bit, I think, but no, I thought his presentation was great, and I'm excited to work together with him. So when we think of goals, buy a rental house or buy a vacation house is not really a goal, right? So if you look on the right side, buy a family vacation home that has beach access, is 2 bedrooms, has a screened-in porch, has a deck. It's within 3 hours of our house. We need $20,000 for the down payment, and we want to buy it within 2 years. We can kind of put together a plan that can kind of tackle all those steps. So if you look at rentals, do your research on if it's going to be a short term. Hey, check out that AirDNA website. Find out what the zip code looks like for your rentals. Come up with a plan of how much you want to invest. What does your return look like? So thinking about goals, delay, click, go. There we go. I'm sure y'all heard of SMART goals. Specific, measurable, time oriented, time relevant, resource defined or relevant, and then what the action steps are. So how can we take the goal and then actually kind of break down the steps we need to accomplish it? And also, your goals are going to change over time. So we're always going to kind of reevaluating your plan and how your properties kind of fit into that context of that plan. Risk versus reward. Everyone kind of knows, hey, the more risk I take on, the greater reward I can get. But we also want to consider, not only your tolerance for risk, but also your capacity for risk. So as we can kind of consider and balance capacity versus tolerance, we want to think of, all right, so what's the investment time frame? How long, what's our soak time going to be on this investment? What's the time horizon? If you need capital back out in 2 years, real estate, a property may be a longer play than 2 years, or, equities might not be right in 2 years. Thinking about what the time frame is, what your stable assets are. With our clients, we always recommend, we kind of want to target between 3 to 6 months, emergency fund for their personal plan. So you kind of want to do the same thing if you're evaluating real estate. All right, what am I going to set aside toward those things that Drew mentioned? And then your income stability. If you're planning on that extra $170 a month helping cover the bills, I heard Bodie kind of talk about this earlier with his side job. That's probably not the best plan. If we kind of know, all right, we have a stable job, say at the base right now, we can plan on a set income level, and then if we have extra resources above that, then it makes sense to take on a little more risk, put those assets to work. I don't like gambling with kind of bill money, essentially. Thinking about what the opportunity cost is with each investment. Whatever dollars we allocate toward investment, whether real estate or asset or equities, it means there's dollars we're not putting toward another investment. So calculating what that cost is, and then we can kind of choose between investment A, B, C to make sure it's the right fit for you, your portfolio, and your plan. Thinking through the market in general, we call this slide the quilt. As you can see, all different colors everywhere. This represents kind of the 9 different asset classes over the last 15 years and what their average return is. So as Drew mentioned, kind of market cycles, market timing. So we're currently in, at Northwestern, we're predicting a mild recession this year. As you see, the Fed is tightening the money supply. Rising interest rates signals the end of an economic cycle. So we're on kind of tail end. As a mild recession happens, then money loosens up, and then the economy starts opening up again. So thinking about what asset classes perform well in each market, they're all different. So you look back at this slide. I know the font's a little small, and I wish 2008 was still on here, but it does the last 15 years. But 2008, for example, large cap stocks, those are companies that are 10 billion or greater in revenue. They were down 38% in 2008. And the next year in 2009, they're up 26%. And if we look at real estate was down, that same time frame, was up the next year in 2009, 28%. And the real estate actually led the gains in 10 and 11, and 14, 15, and 21, up 45% in 21. And the real estate you see on this slide is based on a REIT, which is a real estate investment trust. And so it's a collection of rental properties that you can trade on the stock market. But it gives you an idea for how real estate performs in general. As Drew mentioned, though, real estate is always specific to that property, that deal, that location that you're kind of looking at. There's markets that perform differently, across the country. But on the risk side, real estate is kind of on the highest risk. And just like owning one specific stock is the highest risk in the equity market, because your results are tied to that one specific company. When we put together a portfolio and think of a plan for our clients, we want exposure to all 9 different asset classes. We want to own real estate. We want to own some commodities. We want to have large cap, mid cap, small cap, because they're all going to perform differently. And the more we spread out the asset classes, the better we can kind of weather any ups or downs in the market. Part of our job is figuring out what this income need is, and if it's kind of long-term retirement income, we want to make sure we're not overexposed in any one section, so we're in it for the long haul and make sure we kind of get the desired outcome. So a lot of questions I get also as a financial advisor are, hey, can I buy real estate through my IRA? And the answer is yes and no. In a traditional IRA, you cannot own real estate, but you can use what's called a self-directed IRA. This slide is from the Equity Trust Company. I know a few investors that Diana has that use that to purchase real estate. And so some common questions are, can my IRA, my self-directed IRA, invest in a newly formed partnership? So if 2 y'all wanted to get together and form a company and buy rentals, yes, it can, as long as that company is solely invested in real estate. What if I get rental income? Does that money have to go back into my IRA? Yes. You can use the IRA also to renovate reinvest in the property, but 100% of the proceeds from that property have to go back into your IRA. So it does allow you to purchase real estate, and the custodian who holds that IRA, there's generally a higher fee for having that custodian, because they're going to be the ones who are giving you the tax documents every year, making sure that your IRA is compliant with the IRS tax codes, and they're the ones, if you buy a property, are going to mail them the check to the title company at closing and be able to, and they'll hold the title in escrow for that trust. We call this the good old bucket slide. If we're thinking through long term with our clients, retirement income is one of the biggest things that people ask us about. Hey, like, when can I retire? When can I kind of reach that work optional lifestyle? Where I do what I want to, but I don't really have to go in tomorrow, So thinking about how we build our clients' portfolios and build income in such a way that it's tax efficient, and you're also, again, just like our approach to investing, it's diversified. We don't fill up just one bucket. So if you see concentrated assets up top there, that is going to be real estate, land, enterprise value of a business. It's in a concentrated bucket. It usually isn't the most liquid bucket, because you have to sell at some point. Deferred annuities, that's like pension plans at work. Non-qualified is just any regular after-tax dollars you invest into mutual funds or stocks. That's considered non-qualified. You pay either short-term or long-term capital gains when you sell those positions. Qualified money is an IRA, 401k, 403b, any tax qualified account. You defer the tax on the contributions to that account, and then in the future retirement, as long as 59 and a half or more, you can access those dollars, but anything you take out in distributions is counted as ordinary income tax. So you pay tax on that in the future. You don't get to skip tax forever. You got to pay it when you take it out. Roth, on the other hand, is after-tax dollars going in. The money grows tax-free, and any distribution you take out is tax-free to you. So, which sounds awesome. Roth is great. However, there are more restrictions on the amount you can put in a Roth each year. Currently, it's $7,000 plus. If you're over 50, there's a $1,000 contribution catch-up. So you can put up to $8,000 a year. But there's also income restrictions. If you make more than 160 and you're single, you're phased out of eligibility. If you're married, filing jointly, it's 220 or higher, you're phased out of eligibility. There are some backdoor loopholes. You've probably heard of backdoor Roth or mega backdoor Roths. You can contribute to an individual IRA and then kind of swing it in the back door, do a conversion. But there's a limit to how much you can put in that after-tax bucket. Also, life insurance there's some very good tax benefits to life insurance. It passes, anything you don't use passes through tax-free to your estate, but you can build cash value and equity in life insurance policy and take that money out tax-free from the policy as a loan against the death benefit in the future. And we'll talk about a little more in a slide or two about kind of some ways you can use that. There's two main types of cash value life insurance that we use for our clients. There's whole life, which you've probably heard of. That dividend is paid based on the general account of the insurance company. And then there's something called variable universal life, or VUL. It's a life insurance policy that's invested into the stock market. And so it can earn a higher rate of return, higher yield than whole life does, but there's more risk to it because it's invested into the market. All right. So Drew mentioned momentum earlier. So as you are investing in real estate or in equities, the dividends you earn, the income you take, If you take it just as cash to yourself, you're going to lose that momentum. Has anyone heard of the rule of 72? All right. So if you take your expected rate of return and you take 72 divided by that, that'll tell you how long it'll take to double your investment. So for example, if you get a 7% rate of return on a stock portfolio, it'll take you 10 years to double your money. And then 10 years it doubles again. So in 20 years it quadruples. Same thing applies toward real estate, any investment. You can kind of figure out what your rate of return is, how long it will take you to double your investment. Now, as you are reinvesting, more money is growing. So you're kind of compounding your growth as you kind of invest that dollars. I want to talk about a few options you have in terms of how you can leverage some assets you have and kind of be creative in how to finance rentals. So we talked about qualified dollars a few minutes ago. You cannot collateralize a qualified retirement plan. So, or a Roth. Roths or IRAs or 401ks cannot be used to secure a line of credit. But you can use either a life insurance policy or a non-qualified stock portfolio. Anything non-qualified can be used to secure that line of credit. What that does, it gives you the option to get a lower interest rate. And this is a real life example from another advisor in our office. His two brothers, they own 7 properties right now. He has the cash value of a life insurance securing a line of credit. His brother has a mutual fund portfolio securing that line of credit. They write a check from the line of credit to purchase properties in cash. Once they have the property, so the cash offer allows them to be a little more competitive in the market, get properties quicker. Then once the property is in-house, they work with a lender to finance the property using traditional financing, get a 30-year loan, and then they pay off the line of credit. And then the interest that you pay on the line of credit is tax deductible. You can write that off in your business, in your LLC. So you can use leverage without having to cash out that property quicker, and you can kind of rent, stride, repeat, as Drew mentioned. So you can kind of reinvest and grow, but you need an asset that can be collateralized. I don't recommend using property to secure a line of credit, because if something goes south on your property, then that bank takes over that piece of land or that house. Have a plan going into it, be specific. Understand risk versus reward. What is your risk tolerance and what is your risk capacity? Make sure that you don't take on more risk than is kind of smart for your portfolio or yourself. And then diversification. So whether it's owning property or real estate rentals as part of your portfolio, or it's owning multiple properties. So diversifying not only within your portfolio, but within real estate. The more properties you own, the safer it is. And then time. Again, it's not kind of get rich overnight. You saw Drew's example on what 10 years looks like. So the first year you're making $170 a month. There's not really much equity gained. In 5 years, you've gained your $85,000 equity, and 10 years in, you're at $147. So there needs to be a time horizon toward each investment, and you kind of understand what that is going in. And then momentum. Being able to reinvest in yourself, reinvest in not only in real estate, but also your assets. The more you put in, the quicker that's going to grow, and then it's just going to compound on itself and double. Part of the value that we kind of bring as an advisor, we help kind of sit down, talk through what your goals are, not only just in real estate or rentals, but your total financial plan. We consider kind of all the aspects and help put together a customized plan to help you achieve your goals. We also give you an objective perspective and understand, kind of the discipline to move forward. So as I mentioned in the first slide, volatility is a part of investing. if you try and time the market or, time real estate, time rentals, you need to give it time. And so part of our job is to let our clients know that we're going to help you position your portfolio, your assets for every market cycle. And so we're tilting portfolios now to help perform better in a mild recession. So when it happens, we're not surprised, we're not caught off guard. But if you pull out and take out your investments in down markets and then buy back in at the peak, it destroys your whole plan. So being able to stay committed, stay invested over a long time is how you build generational wealth in your plan. And real estate, I think, can be an important part of that. And then just a little last close on Northwestern Mutual. We actually right now have a higher credit rating than the U.S. government. Since this slide came out, we're now top 5 broker-dealer. And we have a 90% retention of our clients through our advisors. So we've been around since the 1860s. We've been in Georgia for over 100 years, been in Macon for over 60 years. I have a fantastic team that works with me. My investment director worked for over 20 years on Wall Street. He is a really sharp guy, and I look forward to kind of sitting down with y'all and kind of finding out how real estate can work in your portfolio and how we can put together a financial plan for you.
I'm Diana Grinberg. I am an owner, broker, investor on the move home loans. I just got my broker license in December and started my own company. So it's fairly new, and some of the loan products that I'm going to talk to you about today are new to me as well in the last couple of months. I've had trainings on them. I went out and found specific lenders that do a wide variety of loan programs for investors specifically. I was thinking this morning, why am I getting so into investor lending? And I realized when I was 5, my father gave each of us kids $100. And I was one of the younger ones. And he said, you can keep this, you can spend this, or you can give it back to me and I'll invest it for you. Well, of course, I was the only one that kept it and put it in my little money purse or whatever, and then got guilted into giving it to him. Well, that $500 that my father invested back in those years put all of us through college. We all got advanced degrees on that money. And then we got what was left in each of our individual accounts when we were done with schooling. So for me, I realized not until this morning what a huge impact investing in real estate and a whole diverse portfolio made in my life. And I didn't do it. That's my dad, the generational wealth. And that's what I'm hoping to do for our kids. So, that's why I'm so involved in the investor. And I have 3 new lenders that I work with that do just like 90% investment loans. So right now, these are the investor programs that I do have to offer. I'm getting with a new lender next week who will do 5 to 8 units. So I can do up to 8 units starting in a week or 2. Right now, all the programs I have are for 1 to 4 family units, because that's what we consider residential versus going into small commercial. So my main lender that I work with and have worked with for about 5 or 6 years has a very, the simplest program that you'll have heard about, 20 to 25% down, full income documentation, good credit score. I think their lowest score is a 620. And they, so all of these lenders do that, but they're the one that has the best rate and the best program, and we can get it closed quickly. So I'm not going to talk much about that today, because since COVID started and the housing shortage started, there have been so many new programs developed that are called non-qualifying mortgages. So they're not your typical residential home loan. So the first one is called a DSCR, and it's a debt service coverage ratio. And this is from one of my lenders. The lowest score is 660, but I just got another one whose lowest score is 620. So when you're looking at these, I have different lenders, and they might have lower criteria or higher, and I work with you to decide what's best for you, for your specific situation. And that's true on a primary residence or an investment property. You really need to talk with your lender, tell them your whole story, tell them what you've talked to your realtor about as far as your market and maybe your investment sales price that you're targeting. Talk with your financial planner and say what's the best place to take money from if you're taking money from somewhere. Then you come to me, so that's why they saved me for last. When you're ready to do this, there are so many programs that I have that today I can't just start telling you every detail about everyone because everyone's situation is different. So, oops, you went on to bank statement. Will you go back, please? So the DSCR, what I didn't explain is that is a no income loan. We don't document your income. We don't want to know your income. We don't need any employment, anything. This is based on qualifying off the rent. So you could go buy a house tomorrow for $100,000, not give us any income. Your credit score would have to be at least 620, is as low as I can go. And what we do is get an appraisal. If the appraiser does a rent schedule, just like they do comparables for value, included in an investment property appraisal is a rent schedule comparable. They'll tell us, the lender, what you can get for rent on that property. We use that number, even if you don't have it leased or rented out yet when you buy it. And if it covers your principal, interest, taxes, and insurance, we can do the loan. Now that's the very simplified version because pricing and everything else is determined on what that ratio is. So it doesn't have to cover 100%, but if it doesn't cover 100%, maybe your loan to value has to be less to make up for the risk. Or as we all know, the more programs that we do that aren't safe for the lender, the riskier the program gets, the higher the interest rate is. Okay, so that's something to keep in mind. This one, 80% loan to value is the highest, so you need to put 20% down on that one. We can go up to 40 years. This lender has some interest-only loan repayments. Some programs do $2 million, up to $2 million or $3 million. This program became very popular with investors in the last 2 years. I have one that we're doing a lot of these now because generally you can only have 10 mortgaged investment properties and then lenders don't want to work with you. That's like where they top out. This program you can have up to 20. Some of the lenders that are doing this program have no cap at all. So long as you qualify, you just keep on buying. This is also one that I can do in an LLC name. So a lot of my investors want to keep their properties in their LLC, and it gets deeded to their LLC, and it's to avoid, all the risks that come with doing it personally. And this is one of the few programs that allows the LLC. I wouldn't worry about the different property types, we can talk about. This one doesn't do non-warrantable condos. A lot of loans for primary even don't do that. So are there questions about this one at all? Okay, so the next one that's been new in the last couple of years is a bank statement loan. Again, we don't get your employment information. Again, we don't get your income. We look at either your business bank statements if you have a business, or we look at your personal statements. We can't do both. They can't just be flowing back and forth. And the reason is because what we look at is the deposits that have been made over that 12 or 24 months. The underwriter, and I always send these to an underwriter before I pre-approve, because they use a variable expense factor. So you may have $1 million in deposits for over 12 months. They're going to use an expense factor to figure out what income they're actually going to use. They may not use the whole $1 million. So you'll do a little form that tells what kind of business you have, and why you're getting those deposits. And if it's a business that has a lot of labor, you're paying labor costs or material costs, they're going to use a bigger expense factor than if you're a mortgage broker and with no employees. So that's that one. That's also one that's a lot of people have been using on owner-occupied and second homes. But that is there's interest only available. You are required to be employed for 2 years in that same line of work. Just like if you're buying your own personal house, they want that stability. All right, so the next one, and I just got this one recently, is a 1099. If you're self-employed, well, not self-employed, you're a contract employee, and you get a 1099, don't realtors get a 1099, Drew? Yeah, so if you're Drew and he's coming and wants to buy an investment property or any property, I now have a program where I just look at his 1099s. We don't say, give us your last 2 years' tax returns, because we're going to go through your Schedule C or whatever type business you formed. We're just looking at the 1099s. And again, they're going to ask you to fill out a form, what kind of business is it, so they can determine what percentage of your 1099 income they're going to use. Okay? My end of the talk is more about not what you have to do to decide if you're going to be an investor, or what you have to do to decide what your niche is in investing, or how you're going to diversify your investment portfolio. Mine is to determine what is the best product for you, what you qualify for, find out if interest rate is the most important to you, or is down payment what's most important, or is income hard to document, so we use a different type of program. So mine is really like putting the puzzle together for you. The other thing that they will use, Bodie, to take some of the risk away, and I know these guys talked a little bit about it, is you have to have reserves. You can't be an investor that just goes in and pulls from your 401k and takes a loan and buys this property with no experience and have no money left, right? So to negate that risk, the lenders are they'll look at your credit score, they'll look at, it depends on which program, they'll look at how stable your income is, all of those factors, and they will determine, based on what program you fit, how many months of reserves you have to have left after closing. So it might be, I think the longest I'm really seeing now is about 6 months. 6 months of mortgage payment somewhere. Can even just be a retirement account. But they want to know that and that takes away the risk of them saying, well, this hasn't been rented, but here's the comparables the appraiser's telling us about in the area and what they're getting, so we'll go with that. But you can even do that on a more conventional loan, where we do fully document your income, pull your credit, and your credit score's good. You can do that same thing. We have investors, Drew and I have worked with, that we can get that rent comparable with the appraiser, and they will use that. So that's not just on which DSCR or bank statement. Okay. So this is why I was talking about the non-qualifying mortgages is what the government calls them. And we can do all different kinds for income. We can do up to 4 units, up to 90% LTV. Now, if you're an investor and you're getting a 90% loan to value, there's going to be a little interest rate or fees or something in there because that is a risk, generally. This particular lender does not require mortgage insurance on their loans up to 90%. And if you know about loans for even your own personal loan, mortgage insurance is required anything over 80% generally. Oh, delayed financing is something, so this is one where when you're starting to get in it, if you buy, say, your first one, Eddie, with cash or out of a 401k or something, within 6 months of doing that, they will refi that property so that, and pay you back for what you spent. So it's not a cash out product, but it gets you into a product with a loan. And hopefully within 6 months, if you're doing it then, the value has already gone up because if you bought it cash, you're probably doing renovations or some kind of improvements. So this is purely just something they came up with again during COVID, where we'll go ahead and do a refi for you within 6 months. It used to be you had to hold property for a while before a lender would ever do a refi for you. Okay. So this is brand new to me, so I'm going to be really honest. This is the lender that I just started working with. I have not done this. This is another one that I would send directly to the underwriter and say, calculate before we start looking for this property or write a contract. So this one is asset qualifier, means we're not looking at income, we're not doing all that. We're saying, hey, do you have a retirement account has $1 million in it? We'll do a loan. Don't need to see anything else. And then the asset income lift loan is we look at your assets. If you don't qualify just on your income, we'll look at your asset portfolio, retirements, IRA, 401k, whole life, all of it, and we'll say, okay, we're going to add that to the income we already got from your bank statements or your W-2s or your 1099. So there is a calculation, and that's why I said I'm not good at this one yet, where they look at your assets and use a certain percentage of it. And it depends on things that I do not know yet. So, but I wanted to let you know those are out there as well. That's why I brought that up. Okay? Any specific questions? Nope. Okay. Thank you.